Good evening. Welcome to our Long Beach State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. I know we got a very busy week with the 4th of July, so thanks so much for taking time out of your schedules to join us for tonight's class. Tonight's class is being recorded. We're also going to share back all of the slides that you see this evening via email tomorrow. So if you have to step away for a second, we'll make sure we have this recorded for you. This is a very interactive session that we provide 4 times a year for the Long Beach State Alumni Association. So really excited you get a chance to be with us. If you do have any questions as we go through tonight's presentation, you can use the Q&A or the chat function within Zoom. I'll be kind of monitoring both of those sections as we go through this evening's discussion. Well, just a little bit about our organization. So we've partnered with the Long Beach State Alumni Association to bring educational resources like our home buying class to the local community to help really support you on, which is probably going to be one of the largest financial decisions you decide to make. Our organization, American Pacific Mortgage, is the 9th largest lender in the country. We're an independent mortgage banker or lender, which provides direct resources to buyers. Myself, again, my name is Jason Maida. I'll be your facilitator this evening. I'm also a branch manager with American Pacific Mortgage, and we teach very similar classes like this all across the country through our different partnerships. In tonight's discussion, we're going to talk a little bit about the housing market, what's kind of happening with it, a lot to go through and digest there. We'll also spend some time looking at interest rates, and then kind of really start talking more through budgeting for homeownership. What could that look like for me? This is going to be one of the biggest financial decisions you decide to make. So let's kind of figure out from a budget perspective what that looks like. We'll also look at credit and how do we prepare for homeownership. Also outline some different programs that can help support you on this path of buying. And then one of the challenges that we seem to find with most buyers is savings for homeownership. So we're going to walk through a savings plan to help you get equipped to have the right resources around you to be able to purchase a home. That does also include like first-time homebuyer programs that are available to you. So especially if you're based out of California, there's some wonderful programs that we'll highlight in tonight's discussion. And then we'll also talk a little about the buying process. So after tonight's workshop, you might just want to find out, like, how do I get started in the home buying process? We'll walk you through our get started information to start that path towards home ownership. All right, so that's our plan for our discussion tonight. We appreciate, again, you guys joining us for this evening's discussion. Let's first of all talk a little bit about, does buying make sense for me? It is one of the biggest financial decisions you're going to make. And so when we think about home ownership, there's a lot of great attributes that come along with owning a home. For example, when we think about monthly budget, when we have home ownership or we're aligned with home ownership, we have more of a fixed budget. Now we don't have to worry about every year our rent raising based upon the landlord increasing that cost. So we have more of a fixed budget. And many of our clients that are buying in today's market, they're buying at more elevated interest rates. However, over time, as interest rates go lower, they are going to have an opportunity to hopefully bring down the cost of their housing by refinancing to lower rate options. This is an asset that should appreciate over time. So as that home goes up in value, as I decrease the balance of my mortgage balance that's owed, that creates home equity for myself. And for most of us across the country, that's our number one asset that we have, which has an asset that can really create generational wealth for many families. And there is still some tax benefits that come along with owning a home, still the potential tax deductibility of mortgage interest. Plus, when I decide to make energy efficient improvements to my home, that also can be a tax benefit to me. So a lot of great things that come along with owning a home. And so I always encourage clients to, when we think about home ownership, not necessarily match up a $2,500 rent payment to a $2,500 mortgage, because we really want to factor all the great things that come along with owning a home. Now, when we consider home ownership, I think it's important to also understand, what's my budget going to look like for home ownership, right? So we want to kind of walk through a really simple, like, what if scenario in our budgeting tool. And I'm going to screen share that for you right now. In fact, you can find this up on our website. This is one of our rent versus buying tools that you can run your own calculation accordingly. For tonight's class, and just to kind of frame things up for you, I went ahead and just pre-filled this calculator for you so you can kind of check it on your own. I would encourage you to run your own calculations when you have time. But ultimately, when we're looking at home ownership, we're going to compare our rental budget versus what our home ownership budget But when we look at the home ownership side of the equation, we want to factor in, like I said, the tax deductibility benefits, home equity appreciation, all those things that come out of home ownership. So if we look at this calculator, I'm just going to kind of share this with our class here. So if you, let's say, looked at a price of $700,000 as a home price, the minimum down payment to purchase as a first-time buyer is 3%. So in essence, we would be financing $679,000 or 97%. If I look at the mortgage calculation, I would think about, first of all, interest rate, right? So interest rate average is around 6.7 to 6.8. Most first-time buyers are going to elect a term of my loan at 30 years. And then just for this exercise, we put assumption that we're going to buy our house in July. We have mortgage insurance, which you're going to learn about in tonight's class. So PMI, also known as private mortgage insurance. We have homeowners insurance, which varies based upon where I want to purchase in the state or whatever location across the country. We have property taxes. If we bought a condo or maybe a townhouse, you would have HOA expenses. Okay. And then so that kind of gives us our framework for owning a house, right? So, and then if we look at what we're doing today, let's say we're renting for $3,000 a month in rent. We're going to make the assumption that my rent will appreciate about 2% on an annualized basis. And then I also have renter's insurance costs. So those are some of my existing expenses that I have today as a renter. So if we were to look over the next, I put in 7 years of owning a home versus buying, you can see our breakdown here of our results. The cash spent of buying, of course, with the purchase price and the payments that I would make in mortgage versus renting. Owning a home becomes profitable for me. So I'm starting to break even on my money at year 5. But in year 7, I really see the gain. So what I mean by that is with my tax benefits, my equity appreciation, after 7 years, my opportunity of owning versus renting is just over $45,000. So instead of me paying that rent on a monthly basis, probably paying my landlord's mortgage, obviously I'm paying towards my own mortgage. Now, the other side of the equation is look at my equity position after 7 years. So potentially, if we assume a nominal increase in appreciation, that I would actually achieve about $244,000 in total equity over that 7-year course of time. So we're going to pass along these slides to you after tonight's class. And so I would encourage you, if you have some time, dive into a rent versus buying calculation tool like we've provided to you tonight. I think you'll find that to be a very enlightening exercise. Now, as buyers are considering going in today's market, obviously where prices are at will dictate if it's the right time for them or not. We are seeing a bit of a pivot in today's housing market. Homes are staying on the market a little bit longer. If you look at the Long Beach area right now, we have average days on market about 37, median days on market about 37 days. That is longer than we typically see. Some other parts of the country, you're seeing 2-3 months on market as the median. So that is changing quite a bit. So we're seeing a little bit of a pivot in the market. The Long Beach market per se, I wouldn't necessarily categorize it as a buyer's market, but it certainly is shifting. Other parts of the country, it is 100% a buyer's market. We've always had the challenge of inventory across most communities that we serve, but we are seeing more inventory stack up. So there's more supply for buyers. Now, right now, we're in the summer buying months. I think it was the first day of summer just a couple weeks ago. So this is traditionally more of the active times of the year. Of course, there's a lot going on in the world right now, but at the same time, it is generally a kind of a busier time in the housing market. So I don't, what's going on right now is not necessarily pushing buyers to the sidelines, but I don't think there's as many buyers active in today's market as you might see. A lot of what is maybe pushing people back to pause or stay on the sidelines could be interest rates. And while, interest rates remain at higher levels, there still is an opportunity to enter the market for buyers that are really financially ready to take advantage of what we're seeing in today's market. So while rates remain high, inventory is starting to stack up. That's when a buyer could potentially enter today's market as an opportunistic time. Now, as interest rates drift lower, and they certainly will drift lower at some point, our projections show interest rates starting to come down in 2026, the buyer demand will pick up. So when we see the backlog of inventory, that might not exist maybe in 2026 that we're seeing today with elevated interest rates. Interest rates are right around 6.7 to 6.8 in today's market. We gave you kind of a snapshot of what we're seeing over the last year in interest rates. It's kind of been really a bit of a bumpy ride. We're seeing some encouraging signs that perhaps the Federal Reserve may cut interest rates in July. We're starting to see inflation cool a little bit. That's much of why we're here in this position with higher interest rates. The Federal Reserve has ratcheted up the federal funds rate in order to combat inflation, as well as to see stronger labor markets. And so ultimately, we are at elevated interest rates, but interest rates will cycle over time, and you can kind of see that indicated on our 20-year slide. Interest rates are very similar to what we saw in the early 2000s. The prices of homes obviously were significantly lower back in the early 2000s, but as you can see across over the 20 years, interest rates do cycle. Our graph here depicts some of the major economic crises. You can see the housing crash of 2008. Interest rates were still at pretty elevated levels. And then the pandemic in 21, where interest rates touched down at their lowest levels ever, which is 2.5%. The question I get often from future buyers is, when are interest rates going to return to those levels? And highly unlikely unless something catastrophic happened. But, I think on an average basis, you're going to see interest rates historically be right around the high fours to maybe low 5% range. Now, all interest rates aren't the same for all clients that pursue a mortgage. There's different factors that go into the interest rate calculation, things like credit scores and eligibility of a product, the type of program that they're going to select, how much they decide to finance, what their down payment looks like, as well as if they decide to make additional contributions and expenses called discount points. Now, in today's market where interest rates are still elevated, we don't necessarily recommend clients buying into discount points, because 1 point is the equivalent of 1% of my loan amount, which will usually lower my interest rate about 0.25%. So we don't really recommend that in today's market, because the break-even point for those kind of investments is about 3 to 4 years. Now, another way to get a lower interest rate is to change the term of my loan. Traditionally, most first-time buyers are going to elect a 30-year term, but if I decide to shrink that term down to maybe a 20 or a 15-year term, that can also give me an advantage of a lower interest rate. Now, I have the opportunity of working with clients in designing their home buying plans. And as you decide to take those next steps in home ownership with us, we'll just figure out what the right home buying plan is for you. And we do a comprehensive consultation to walk you through all of those options. Now, as we prepare for home ownership, credit is a conversation that we're going to have to talk through a little bit, because as you just heard, interest rates are based upon credit and then the eligibility around certain products. Now, every product has a minimum credit score. You can see some of those programs set right here. You can see those noted. 580 for an FHA loan, a Fannie Mae Freddie Mac conventional loan is 620. The VA home loan is 620 for our veterans that have that eligibility. And then usually for some of the state first-time buyer programs, it starts at a minimum credit score of 640. Now, we're going to talk about other score factors and kind of give you some tips around managing through those components of your credit. Things like credit utilization, how do we pay down credit card debt? Bigger events that are on our credit report, like bankruptcies or short sales or collections, those are going to have a bigger impact on our credit score. Usually within the most recent 12 to 24 months from the event, that is going to impact the score. And then when we think about the credit score that we use in lending, we look at all three bureaus. You guys are very familiar with those agencies. There's TransUnion, Equifax, and Experian. We take the middle credit score of all those three agencies' scores. So if my highest score is 760, my middle score is 740, let's say my lowest score is 720, we're going to take 740 for the qualifying score for our eligibility. Now, if my partner is going to join me in qualifying for my financing, let's say they're at 700 as their top score, 680 is their middle score, and their lowest score is 660. That 680 score is going to be what's used for qualifying purposes. So that's important to understand, because it could change the framework of the financing and also the inputs like mortgage insurance cost and interest rate, because we'll be looking at that lowest middle credit score between both clients. Now, here's what some of those negative items that appear on your credit report. This is how long they'll remain on your credit report. So this matrix kind of gives you an idea of how long those things will stay there. Now, the way it works in the credit in the credit model is that if I've had events, negative items on my credit report, whether that be a new collection that appeared on my credit report, maybe it's a hard inquiry, generally it's going to have the most effect within the most recent 1 to 2 years from the date of the event. But you can see how long, and this matrix kind of shows you how long those items will stay with you on your credit report. Now, there are three different models to credit scoring. There's a credit card model, there's auto financing, and there's the mortgage model. Of course, if you decide to apply for home buying financing, we're going to use the mortgage model. Many of you that are using monitoring services like Credit Karma or some of the agencies' monitoring tools, they are going to give you a credit card model. So what we find is that credit scoring could look a little bit different between the credit card and the mortgage model. So, don't be alarmed if you have a 760 credit score on Credit Karma, but maybe we have a 750 score in the mortgage model. It's just because there's different attributes or weightings that we're looking at within the credit card model. So let's kind of take a look at that model here. You can see 15%. It's going to be how long have I had credit. So the more mature my credit file is, probably the higher my credit score is. So if I've had credit for 6 months versus another client that's had credit for 6 years, that would change what my potential credit score looks like. The next weighting is how much new credit am I trying to get access to? So am I trying to open up a lot of new accounts? Do I have new inquiries on my credit? That is 20% of the weighting. There are two different types of inquiries. There's a soft inquiry and there's a hard inquiry. Now, the hard inquiry can have a direct impact to your credit score, and you really want to limit the access of those hard inquiries. Soft inquiries do not, and that just allows someone like myself, a lender, to have visibility to your scoring and your pay history without impacting your credit score. Now, in our pre-approval process for clients, we only start with a soft credit check. The reason why we choose to do that is because for many of our first-time buyers that we consult with, it's the cycle time of buying, it varies, right? It could be 2 to 3 months, it could be 2 to 3 years. So we want to provide you all the benefits and resources to understanding buying without impacting your credit score. Now, as we kind of move along here, 30% is how much I owe on my credit card debts or revolving debts. That's called credit utilization. So if I look at my balances versus my credit limits, ideally, I want to keep those balance at 10% or lower versus my credit limit. So if I have $10,000 in limits, I ideally want to have the balances below $1,000. Now, if I'm running currently at $8,000 in balances, that means I'm at 80% utilization. I want to do my best to get that level of credit indebtedness to 50% or below as a starting point, and then ultimately work to 30% and then to 10%. Now, here's one of your tips for tonight in credit. If you were to look at one of your credit card statements, there's two statement dates that are really important for you. So there's the due date, but there's also the billing cycle date. So what happens is when the billing cycle date closes, that's when the credit card issuer sends out all your account information to the three bureaus. Now, our tip for you tonight is that if you can pay down or pay off the credit card balances before the end of that billing cycle date, what that's going to do for you is give you a much lower credit utilization and available credit, but also elevate that credit score. And especially if you do it before the billing cycle date, now you've improved your credit before the debt has been reported out to the agencies. All right. Now, the last component is payment history. That's how I'm basically paying on my bills. If I've had any late payments, they're rated as 30-day lates, 60-day lates, and then 90+ day delinquencies. The more severe the delinquency on my credit, the bigger impact I'm going to have to my credit score. All right. So as we kind of stay within the same kind of context of credit scores and credit reporting, inevitably student loans can appear for our clients on their credit report. So it's a conversation I have with clients as we build their home buying plans. Are we in a repayment right now on our student loans? Are we in deferment? Do we have a forgiveness program available? Whatever the case may be, in lending, we always have to examine student loans and determine what that minimum payment is because it gets factored into the expenses for qualifying for a home mortgage. So if today I have $75,000 in student loan debt and maybe I'm in an active income-based repayment amount that's say $250 per month, then we can use that $250 payment for qualifying purposes. Now, if you're in a situation where you have a forgivable program, but let's say you have forbearance or deferment. That forgiveness of debt will occur down the road, but actively today, if we're qualifying for a mortgage, we do have to count a minimum payment when it comes to qualifying. For example, if we have that same $75,000 in debt and we're applying for an FHA loan, we would use 0.5% as a payment factor. If we're qualifying for a Fannie Mae or Freddie Mac conventional loan, we would use 1% of those balances. And that would be a 750 payment that would be counted into what we call as debt to income ratio. And we'll do some teaching on that a little bit later tonight. But ultimately, as you think about student loans, even though you're not in active repayment, we do have to consider some type of minimum payment into the qualifying. All right, and the reason why we have to do that is because every loan program has underwriting guidelines or standards that we have to meet in the lending world. And so in this part of tonight's class, I want to just give you kind of a high level look at some of those loan programs that are available to you. A lot of this terminology you've probably seen or searched online so far, but I want to give you a little bit more context around each one of these products. So the first product is a conventional home loan. That would fall under Fannie Mae and Freddie Mac. You're seeing more Fannie Mae and Freddie Mac in the news, whether that's pressure from the head of FHFA on Jerome Powell in terms of interest rates, and you're hearing some talk out there. So the head of those agencies is kind of putting some pressure on interest rates, or you're hearing about privatization of Fannie Mae and Freddie Mac. But more importantly, Fannie Mae and Freddie Mac control about 60% of all originations done in the lending world. The minimum down payment for a conventional loan is 3% of the sales price, minimum credit score of 620. Now, every year, FHFA sets the conforming loan limit for each loan product under the conventional loan set. So the maximum conforming loan limit is right around 806 in across the country, but in certain areas like the LA County market, you can go up to higher loan amounts, which the maximum loan amount is 1.209750. That's what we call as the high balance limit. As I go beyond that 806 conforming loan limit, the minimum down payment jumps from 3% to 5%. The next product is an FHA loan. It's called the Federal Housing Administration loan. That is a government insured loan. Minimum down payment of 3.5%, minimum credit score of 580. And just like the conventional product, we can go up to $1,209,000 in loan amount. However, every county has a standard loan amount based upon cost of living and some other factors, but there's a loan limit set by each county. So if I went to San Bernardino County, that's going to look a little bit different than, say, LA County. Now, I want to draw your attention to both the FHA and the USDA products. So those are both government insured loans. And we've had some changes in that product set going back to May, where they have made some eligibility changes with those products. So in order to achieve either one of these loans, a client has to be a permanent resident. Unfortunately, these changes were made. So, unfortunately, we can't lend to non-permanent residents with this particular product set. However, the conventional loan does still allow non-permanent and permanent residents for the conventional product. The USDA product, since we're still in that space, the USDA product is a government insured loan. It does stand for the United States Department of Agriculture. It's designed to support buyers that are looking to purchase in more rural areas. It does have a zero down payment option, which is a nice feature of it, and a minimum credit score of 620. Now, that maximum loan amount of 806,500 does vary based upon location. USDA has two kind of key factors. We're looking at income for the total household for eligibility, as well as the location of the property. And then the jumbo loan exists for clients that need to purchase beyond maybe some of the limits supported by Fannie Mae and Freddie Mac on the conventional loan product, with minimum down payments of usually 10 to 15% down. That usually has higher credit score requirements. And again, we're going to be looking at higher amounts financed with the jumbo loan product. There also is higher asset requirements generally with that product. Last product I want to touch on is our VA home loan. Those are for our veterans that have served and have eligibility under that product. It is a zero down payment option, minimum credit score of 620. There really is no maximum loan amount on the VA product. It's designed to support and provide entry to home ownership for our veterans with as much flexibility as possible. Now, we also have other kind of niche products available that we don't have highlighted here, but we have a physicians program that can help residents in medical school, active practicing physicians, veterinarians, dentists to be able to have a little bit more relief in terms of qualifying when it comes to like student loans and whatnot that we might see in some of the program guidelines with, say, a Fannie Mae or Freddie Mac loan. We can certainly talk about that in tonight's class if you guys have any questions around that product set too. All right, let's talk a little bit about PMI. So PMI stands for private mortgage insurance. There's going to be two forms of mortgage insurance we're going to talk about. So not just the PMI side of it. We're also going to talk a little bit about MIP, which is mortgage insurance premium. PMI comes along with a conventional loan. MIP comes with an FHA government insured loan. Now, ultimately, these mortgage insurance options provide insurance to the lender against default by the buyer. So the lender's protected if in case anything happened to the payments from the buyer to the lender. Now let's talk a little bit about what PMI looks like on a conventional loan. So there's three different kind of key calculations that go into what PMI looks like for you from a dollars perspective. So it is based upon down payment, credit score, and then how much I finance. And then we come up with a premium based upon those risk factors. Now, one of the advantages to the conventional PMI, it does have a cancellation option so that once I achieve 2 years in my home and I have 20 to 22% equity, I can have mortgage insurance canceled on my home loan. So the lower my amount of down payment is, lower my credit scores, that could bring up the cost of my PMI. Vice versa, if I have a higher down payment, higher credit score, then I'll see a reduction in the cost of PMI. So if I was to say, let's say finance $600,000 and I'm going to put 3% down to purchase my home and I have an average credit score of about 740, my PMI costs are about $185 a month. Now, as a side note, a lot of our clients that get a chance to consult with us have already started doing some searches on, let's say, Redfin or Zillow, which is great. But if you've used those calculators in the past, they might give you kind of a false sense of what that mortgage insurance looks like. Usually I find it's a lot higher than what we're quoting here. More often than not, it's just because of the calculation basis that we've kind of outlined this evening. Now on FHA, it looks a little bit different in terms of mortgage insurance. There's two factors in mortgage insurance. It's monthly mortgage insurance, which is 0.55% of my total loan amount. There's also upfront mortgage insurance, which is 1.75 of my total loan amount. Now, that's upfront mortgage insurance because it gets financed into our total amount finance. Now, that mortgage insurance on FHA cannot be canceled at all, just like the conventional product. It does require us to refinance out of a FHA loan, maybe into more of a conventional product. So as I design home buying options for clients, FHA is really more of a temporary solution because FHA provides a little bit more flexibility and guidelines, whether it be credit score or maybe we've had some past challenges. Maybe there's a late payment on our credit report, whatever the case may be. But FHA can be an entry point to homeownership as we improve things like credit score, maybe our overall expenses. Then we'd be looking to refinance possibly into a conventional home loan product. Now, this is what the FHA calculation looks like from a mortgage insurance perspective. So the upfront MIP is about $10,500, and then the monthly MIP is $275. So expense structure a lot higher on the FHA loan versus a conventional loan. However, a little bit more flexibility to help support our buyers in getting access to home ownership. You might also find with the FHA loan, if you've done any interest rate searches, the interest rates show a lot lower than, say, the conventional product. But if we look a little bit deeper on that product, like I said, the mortgage insurance is quite a bit higher than what we see in conventional products. Of course, as we get a chance to connect with you for your consultation, we're going to figure out what the right design looks like for you in your financing, whether that be under the conventional or FHA or any other product that works best for you. Now, we're going to kind of transition a little bit into talking about qualifying income. And you may have some certain scenarios with your own income that you're trying to figure out, like, does this work for qualifying and financing? So let me point out a few things for us in tonight's class. One is, here's the list of the documents generally requested from us when it comes to figuring out your eligibility for financing. Things like W-2s and tax returns and bank statements, recent pay stubs, things of that nature we'll ask for. Now, in qualifying clients with their income, we generally have to evaluate a 2-year income history. But that can be inclusive of educational history. So if I graduated from Long Beach State in the fall and I started my new job January 1, if I can put together at least 2 years of history between my education and my new work, that would help me qualify in my home financing. So we usually look for a 2-year work and or educational pattern or history, I should say. Now, other scenarios, it looks a little bit different. So if I'm self-employed, I have to show that I've had my business active and filed taxes for 2 years. Even if I'm an independent contractor that gets paid 1099, that's technically self-employed. I do have to show myself as having my business for 2 years. If I work dual roles, right? So sometimes we'll have clients that work 30 hours for one employer, maybe another 30 hours for a different employer. In order for me to count both sources of income, I do have to show that I've been on both jobs simultaneously for 2 years. Now, if I have a 40-hour work week job, and let's say I work for Uber or Lyft on the side, now that is a 1099 position. But in order to count both sources of income, so my full-time job and my side work, I have to show that I've been doing both jobs for 2 years. A lot of our clients may have variable sources of income. Let's say I'm in a base plus commission position. In order for me to count my commissions, we have to show in that case that I've been on my job for 2 years. Same thing would apply for like bonus income or maybe counting overtime income into the calculations. All right. And then some scenarios come to us too as we work with clients. We'll get questions around maybe using additional sources of income. Let's say I have a partner that contributes to my household but doesn't plan on being on my application. I can't use that source of income unless my partner is also going to join me in a joint application for my home financing. Also, things like room and board and stuff like that generally can't be transitioned into the qualifying income for financing unless we're looking at certain products that are going to be like specific to more rental type property purchases. All right. So that's kind of what we see in the income space. Now, we also look at expenses versus income. We call that a calculation debt to income ratio. So as a lender, we're going to figure out, hey, what do the expenses look like that show up on my credit report? What are my new housing expenses going to look like? And we don't want those expenses to exceed a certain percentage because ultimately we're trying to create the best affordability opportunity for our clients. Now, here's what we see in the debt to income ratio calculation. We take the housing expense, which would include our principal and interest of my loan, property taxes, homeowners insurance, mortgage insurance. So we kind of factor that all in. Now, let's say I'm going to buy a townhouse in Long Beach or maybe a condo. Then we also want to bake in HOA expenses into the calculus. So that all gets factored in. And then we also add any other expenses like credit cards, student loans, auto financing, personal loans, all that stuff gets factored in. And we look at those total expenses versus income. This is kind of what a scenario would look like. So if I have a home purchase that I'm going to have a $2,500 mortgage payment and I have $500 in other debts and I'm making about $8,500 a month, my debt to income ratio, so my expenses versus my income is 35.3%. Now, this is a measurement for qualifying under a mortgage, not necessarily an affordability metric, but ultimately the guidelines will allow us to go as high as 45 to even 50% debt to income ratio. But I would say the excellent or the sweet spot for most clients is to have that debt to income ratio is 33 to 36%. Again, this is an affordability metric. When we think about affordability, those are going to be conversations that we have during your consultation to figure out as we go from say $2,500 in rent to maybe $3,500 in a mortgage, does that work for me financially? Is that going to be something that's sustainable for me? And that's part of that conversation that we have in a consultation discussion. All right, so that's how we kind of look at income versus expenses. Now we're going to talk a little bit about assets for your home purchase. So how do we get prepared to save enough resources to purchase a home? You heard a little bit about the minimum down payments, which like 3% on a conventional loan, 3.5% for an FHA loan. We are going to spend some time talking about assistance programs in just a few minutes. But before we go there, just want to talk to a little bit about like how do we verify assets being used in a home purchase. So we can use things like checking and savings accounts, retirement accounts, 401ks, 403bs can be used, brokerage accounts. We would encourage you to talk to your investment or tax advisor before you access those assets because we don't want to create any type of tax situation for you. Gift funds can be also allowed in a home purchase. That's where a family member has contributed, some of their assets to help you with your home purchase. Now, in qualifying for home financing, we do have to verify 60 days or seasoning of the assets that you have. However, with gift funds, there is no seasoning requirement. I will kind of just note that, cash is not allowed in home purchases. Everything has to be seasoned for at least 60 days. Now, for many of the first-time buyers that I work with, this is probably the biggest challenge for most of us. Maybe we're new in our careers. Maybe we're trying to kind of whittle down some debt that we have. So savings can be a challenge, especially in a high inflation market that we're all facing today across the country. As we think about preparing for home ownership, I always encourage clients to think about a savings plan for homeownership. And we've kind of created a really simple formula for that. And it looks a little bit like this. So if you were to be paying, let's say, $2,000 a month in rent today, but after consulting with us, you feel like, hey, I can afford about $3,500 on a monthly basis, we would encourage our clients to start creating a plan for themselves that is almost like saving like I'm making a mortgage payment today. So on the first of the month, when I'm making my payment to my landlord of $2,000, I create that discipline that I pay a little bit extra, but it goes into my savings account. So I get in that habit of paying, let's say, $3,500 a month, $2,000 going to my landlord, $1,500 going to my savings account. And what we do with that kind of discipline is one is we're obviously creating savings for ourselves. So at the end of 6 months, I have $9,000 accrued. End of 12 months, I have $18,000, not to mention on a high yield account where you could also get interest compounding on that money. But also we create that rhythm and habit of making that $3,500 payment because as we transition from renting to home ownership, there's a lot of other expenses that come along with owning a home. But if you've already created that discipline for yourself of paying at that level, you've contributed to savings, but you've also, got yourself and your budget in the habit of making that higher payment. All right. So that's our savings plan. Now, there also are first-time homebuyer programs available across the market. Now, I know many of you in tonight's class are in the state of California. So we partner with an agency called CalHFA, stands for the California Housing Finance Agency. It's designed to support low to moderate income households. In fact, CalHFA in September is celebrating their 50th anniversary as a state agency. And our team is proud to be their #1 provider of these lending products. So you may have heard of CalHFA in the news through some of the products that we've released in the past. Let me kind of give you a little bit of an overview of what some of these resources can do for you. The first product is the CalHFA My Home Assistance product. My Home is an assistance program that essentially reduces down the out-of-pocket expense for a first-time home buyer. On a conventional loan, you can get up to 3% of your purchase price in assistance. An FHA loan, 3.5% of your purchase price. It is a low interest rate loan that the state provides to you at a 1% simple interest rate loan. The nice thing about it is you don't have to pay back those funds until you either sell the home or if you refinance in the future. So it's completely deferred payment. So that's one resource that's available to you. A new product that we just launched several months ago is called the My Access program. That provides up to 2.5% of your sales price 2.5% of your loan amount in assistance. It is a 1% simple interest rate loan, just like My Home, also deferred payment until you either sell the home or if you refinance in the future. And then another product that can be interchangeable with the My Access program is called ZIP Assistance. It's anywhere between 2 to 3% of our loan amount in assistance. It's zero interest assistance, also deferred payment until I either sell or refinance in the future. Now, to get access to the ZIP or My Access program, I have to first start with My Home. And if I need additional resources, we can kind of bolt on those products. Other products available for you outside of the CalHFA space, there's the Pathway DPA program. That's more of an APM branded product. On an FHA loan, 3.5 to 5% of your sales price and assistance. And you may have heard of the GSFA program, which stands for the Golden State Finance Authority program. We do offer that as well. And then the Fannie Mae low-income housing assistance. So there's a lot of great resources for you available as a first-time buyer. If we were to kind of look at applying, say, the CalHFA product set to a home buying scenario, it would look a little bit like this. And if we first of all looked at more of a traditional purchase, someone buying, let's say, a $450,000 home and putting 3% down plus closing costs to buy the house, we would probably need to contribute about $22,000 to $27,000 traditionally, right? So that's what a first-time buyer would need to have available. However, with the CalHFA assistance product set, we take that same $100,000 and $450,000 sales price. We can layer on the My Home Assistance program and cover that down payment, so that $13,500 is satisfied. And then we have the My Access of $11,250. So in theory, a first-time buyer could have eligible assistance of up to $24,750. So instead of a buyer trying to figure out how do I come up with $22,000 to $27,000, maybe it's $2,000 to $3,000. And so for many of the buyers that I get a chance to work with, when we insert things like assistance programs, it can make first-time homeownership so much more of a near-term goal. Instead of having to plan for 3 to 5 years, maybe it's 3 to 5 months down the road. So we'd encourage you to think about looking at the CalHFA product, and we can certainly help kind of guide you through those resources in working with us as your lending partner. Now, here's some of the eligibility requirements for CalHFA. There are minimum credit score requirements. You can see here for each one of their products. There is a maximum debt to income ratio. We kind of talked through debt to income ratio this evening. So it's 45 to 50% on the program. One of the unique things about CalHFA's product is the income limits, unlike other first-time buyer programs, go up to 150% of the median income. In fact, just 2 weeks ago, CalHFA updated the income limits for the program. And the income limits are based upon applicants, not off the household size. So, for example, if I'm going to buy in Los Angeles County today and I make $190,000 and my spouse makes $100,000, combined we make $290,000. However, if my spouse is not going to apply, then that income doesn't get factored into the qualifying, which can make myself eligible for the program, which allows income up to $200,000 in LA County. Now, this product is eligible for one-unit properties, single-family homes, new construction homes, condos, townhouses. Those are all available. Even below-market homes can be available through the product, and manufactured homes if it's on land that is owned. Now, a first-time home buyer is someone that actually hasn't owned a home in the last 3 years. So that's really important. So I may have owned a home back in 2009 and I've been renting since then. Even though I purchased in the past, as long as I haven't owned a home in the last 3 years, I'm still considered a first-time buyer. Now, here's the updated income limits for the Southern California markets. You can see these here. These have all gone up by about, well, Los Angeles County used to be 194, so it's up about 5% year over year. So these income limits get adjusted every year based upon cost of living changes. All right. And as part of reviewing the CalHFA suite of products for you, we'll certainly kind of talk through like your eligibility within those income limits. All right, well, we're going to keep things moving along and talk a little bit about the buying process of owning a home. We've created a visual tool to help you understand a little bit more about what are the next steps after tonight's class. And this is our 6 steps of home buying. So you've heard me mention a little bit tonight about consultations. That's a free service we provide to clients to help create a guide for you towards homeownership or a plan. And from that consultation, the outputs of our session would be essentially to be pre-approved for our home, which would kind of walk us through all of these milestones. And then really the finish line here is at closing of a loan. That's ultimately when I get the keys to my house. So step 1 after the consultation is your pre-approval. That essentially it shows that you're eligible for your financing. It allows you to start making offers on your homes, wherever that might be. Now, the pre-approval is good for 60 days, but it can be easily extended at any time, and we can customize that pre-approval based upon the offers that you're making. So you may be pre-approved at $600,000 for a home, but you might find a home for $525,000. Well, that's great. Now you found a cheaper home for yourself and improved your budget. But ultimately, we can kind of customize that pre-approval as you do your home search. Now, step 2 is the house hunting. That's when you're probably going to start online with your home search and then identify a few properties that fit for you, and then ultimately start looking in person at those homes. We would encourage you to connect with a local realtor because of our network of realtors across the country. We have preferred realtors that we can connect you with, but ultimately a realtor that you select should be an expert in their market, have partners that can help with investigations of the property, and be a good negotiator to help you get the best opportunity for you as a first-time buyer. Well, as you continue to go through house hunting, you may identify a home that you really love, and maybe you decide to make an offer on that house. Well, let's say that offer gets accepted. Then we're going to move to step 3, and that's called entering escrow. That means the seller has now accepted an offer on the home, and it's going to start our escrow process. Now, usually that escrow process, which will run from step 3 to step 6, is traditionally 30 days. It can be as short as 14 days, just depends on how things are negotiated with the seller. So you will negotiate with the seller those timelines. Now, the day your offer gets accepted, you're going to get a call from me saying, congratulations. We heard about your offer being accepted. Let's talk a little bit about next steps. And we're going to schedule you for a follow-up video session with me. And that's where we get a chance to work one-on-one to just make sure your financing is situated the way you would prefer. Well, that would include like where today's interest rate's at, what's your out-of-pocket look like in terms of the cash out-of-pocket, what's your interest rate offering today, assistance programs, all those things we're going to do with your follow-up video consultation. Now, one of your action items as a buyer at that point is to make what we call as an earnest money deposit. That deposit is usually 1 to 2% of your purchase price. It does count towards your total cash contribution towards your home purchase. Now, that deposit is protected in most contracts by what we call as a contingency period. And what that means is that you're making an offer on this home, but it's contingent on certain things being investigated in the process, which would include getting your house appraised to ensure the home is worth what you're buying it for, getting your loan approved, and getting the inspections done in your house. Maybe things like roof inspections or sewer inspections, pool inspection, whatever you think you need to do as a buyer to make sure you feel like this is a good, sound purchase for you. Now, as we move through these milestones, you're going to be getting electronic disclosures sent to you that highlight all of the product offering that we put together at your follow-up consultation. But there's 3 different iterations of disclosures. Within 72 hours of your accepted offer, you get your initial disclosures. Once we lock in your interest rate, you get another set of disclosures, and then we'll talk more about your closing disclosure you get within 3 days of your finalization of your closing of your home loan. Now, step 4 is kind of the administrative things that we do in your financing, things like verifying your employment, making sure the product design or the program is structured properly for you, verifying assets and credit for you, because ultimately we're going to send everything to an underwriting team that's going to complete all the final review of your loan. Now, that'll take us to step 5 at loan approval, where the underwriter has now issued a final loan approval. That also probably takes us to the end of your contingency period, and it prompts us to issue a cooling off period disclosure called the closing disclosure. So that's going to give you a 3-day cooling off period before we can get to the very final stages called the closing of the loan. Now, at step 5, you are at the end of your contingency period. What that means is that if you're satisfied with the outcome of your appraisal, of course, your loan is approved, and your inspections are completed, then you can tell the seller, we're going to sign off on our contingencies. But when we do that, that tells the seller that we're ready to move to the final closing stages in the buying process. Now, that closing stage looks like this. This is the very end, the finish line, if you will, of your home purchase. At that point in time, you're going to be signing final loan documents with a public notary. You will then be required to deliver your final funds for the home closing on that day. And then those monies get kind of reconciled along with the loan financing funds that we're providing as your lender. We'll also include any assistance programs that you might elect within your home buying plan. Those funds then will get balanced out with an escrow company. Then they will record documents with the local county recorder's office. So if I'm going to purchase in Los Angeles County, my documents will get recorded there in LA County. They record usually a grant deed to transfer ownership from the seller to the buyer, and record a deed, which is your basically security for the home purchase that we're financing for you. So after that is all confirmed and recorded, then we get a chance to make our favorite call of the day, which is to say, hey, congratulations, you're now a new homeowner. Huge accomplishment, major financial milestone, and it's certainly a day of celebration. I get a chance to make a couple of those calls today, and it's basically the best part of my day, of course, next to teaching classes like this. Now, our relationships with our clients don't end there. As part of our aftercare program, we're always staying connected with our clients through different opportunities of just making sure they're top of mind with what's changing in the market. We have our Rate Watch program to monitor refinance opportunities, our HomeBot system to track home equity position, because when those refinance opportunities arise, we want to provide the best financial solution to our clients. And we're always kind of checking with our clients on an annual basis because, let's face it, things are always changing financially for our clients, and we want to be here as a resource. Well, as we're getting towards the end of class, we're going to carve out some time for questions if you guys have any. Just want to kind of point out some of our next steps after today's workshop. So if you'd like to get connected with me for your free consultation, we have our Get Started information here. Really easy process. You can complete an online application. We only do a soft credit check, so you don't have to worry about your score being impacted. You then upload proof of documents like proof of income, assets, and then you use our scheduling system here that you can see to schedule a free consultation time for you. Now, this is a service that we provide to help provide you a home buying plan, right? You don't have to feel pressure to buy a home this year. Could be something as a long-term goal for you in 2026 or 2027. We just want to make sure you have all the right support and resources around you to make a big financial decision like this. Here's what our free consultation looks like. We're designing home financing options. We want to better understand, where do you want to purchase? How much do you feel like you need to save for your home ownership goals? What does your budget look like? Are some assistance programs going to be applicable for you? Give you a really comprehensive plan that's going to help you meet your goals of homeownership whenever that may be. Couple other things I want to point out to you. We do have some really great resources leveraging technology. We understand that the buying process is a huge undertaking, so that doesn't, replace the human touch of just making sure we're staying connected with you through texts and calls and emails. But we also have technology through mobile that can help support you. You can start your application via mobile. You can follow the progress of your loan. Also use the calculation feature within the mobile device as well too. Last thing I want to point out to you is, with our partnership with Long Beach State Alumni and Athletics, we do provide a benefit of a discount in our services, not to mention obviously the 4 classes we provide throughout the year. But that discount is designed to create better affordability for you on your path towards homeownership. If you've enjoyed tonight's class too, we'd also encourage you to share this content with friends, family, maybe coworkers. You can see some of our other partnerships across the country that we support with these educational classes. We've found these to be really helpful for clients in taking that next steps towards homeownership. Here's all my contact information. So if you do have any questions after tonight's class, don't hesitate to reach out to me. Again, we're going to have tonight's class recorded, so it's going to be up on our YouTube channel. Those that have subscribed to today's class are also going to get a copy of the slide deck, so you can reference back some of these tools and resources that we've discussed tonight. And as we wrap up, I just want to thank you again for spending time on your busy holiday week with us. Hopefully you found this content super helpful for you, and we look forward to helping you on that path towards homeownership. With that said, I haven't really had any questions tonight, but I want to make sure that I do answer anything that comes from our audience. So if you do have any questions, just drop those in the Q&A or chat function here in Zoom. I'll get those answered before we wrap up tonight's session. Okay, I think we do it. I'm going to say that we were very thorough tonight. That's why we didn't have any questions. All right. I appreciate everyone spending their evenings with us. I hope everybody has a great 4th of July week, and look forward to hopefully connecting with each of you soon to help you on your path towards homeownership. Have a good night.